A pump and dump is a fraudulent scheme that aims to artificially inflate the price of a stock or other financial asset, and then sell it at a higher price, leaving investors with worthless shares. In a pump and dump, fraudsters use various methods to create hype around a stock, often through false or misleading information, to attract investors who are looking for a quick profit. Once enough investors have bought the stock, the fraudsters dump their own shares, causing the stock price to plummet, and leaving the unsuspecting investors with significant losses. This article will provide an overview of the pump and dump scheme, its characteristics, and how it works. The primary characteristic of a pump and dump scheme is the promotion of a stock or asset by the fraudsters, creating a false sense of demand. Fraudsters may use various tactics to promote the stock, including social media, email newsletters, and other marketing channels. They may also create fake news or reports about the stock to mislead investors about its true value. Another characteristic of a pump and dump scheme is the sudden and dramatic increase in the stock price. This increase is often driven by the influx of investors who have been duped by the fraudsters' false promotions. The fraudsters will usually purchase a large number of shares before launching the promotional campaign, ensuring that they can sell them for a significant profit once the price has reached its peak. Finally, the collapse of the stock price is the ultimate characteristic of a pump and dump scheme. Once the fraudsters have sold their shares at a significant profit, they will cease their promotions, and the stock price will collapse as investors begin to sell off their shares. This collapse often leaves investors with worthless shares, and the fraudsters disappear with the profits they have made. A pump and dump scheme often begins with a group of fraudsters purchasing a large number of shares in a low-value stock. Once they have accumulated enough shares, they will launch a promotional campaign, using various tactics to create a false sense of demand for the stock. This campaign often includes creating false or misleading news or reports about the stock, using social media to spread the word, and targeting vulnerable investors who are looking for a quick profit. In some cases, the fraudsters may also employ boiler room tactics, where they use high-pressure sales tactics to convince investors to buy the stock. These tactics often involve making exaggerated claims about the stock's potential and putting pressure on investors to buy before the price increases further. Once enough investors have bought the stock, the fraudsters will begin to sell their own shares, causing the stock price to plummet. This can be done in a variety of ways, including selling the shares outright or using complex trading strategies to offload their shares, while maintaining the appearance of stability in the market. As the stock price falls, investors who have bought the stock at the peak of the hype begin to panic and sell off their shares, causing the price to drop further. This can create a vicious cycle where panic selling leads to further drops in the stock price, causing even more investors to sell off their shares. Ultimately, the pump and dump scheme is a form of financial fraud that can cause significant losses for unsuspecting investors. To avoid falling victim to a pump and dump, investors should be wary of promotional campaigns that create a false sense of demand for a stock. They should also be cautious of high-pressure sales tactics and exaggerated claims about a stock's potential. By doing their due diligence and carefully researching any investment opportunities, investors can help protect themselves from falling victim to this type of scam.